Investors have a range of options available to them when it comes to investing in the stock market, with two popular choices being exchange-traded funds, ETF and index funds. While both of these investment vehicles track the performance of an underlying index, there are some critical differences between the two that investors should be aware of before deciding which one is right for them. If you are ready, then let's start the video. What are ETFs? ETFs are investment funds traded on a stock exchange, like a regular stock. They are designed to track the performance of an underlying index, such as the S&P 500 or the NASDAQ 100. ETFs are popular with investors due to their low fees, flexibility, and ability to trade like a stock, allowing investors to buy and sell shares throughout the day. One of the key benefits of ETFs is their low expense ratios. These fees are typically lower than actively managed mutual funds, making them an attractive option for investors who want to keep their investment costs low. Additionally, ETFs can be traded like a stock, meaning investors can buy and sell them daily at market prices. This gives investors flexibility that is not available with traditional mutual funds. What are index funds? Index funds are mutual funds that track the performance of an underlying index, such as the S&P 500. These funds are designed to replicate the performance of the index they follow, meaning they hold the same stocks in the same proportions as the index. One of the benefits of index funds is that they are passively managed, which means they do not require a team of active managers to select individual stocks. This results in lower fees than actively managed mutual funds, making them an attractive option for investors who want to keep their investment costs low. ETFs versus index funds. While ETFs and index funds share many similarities, there are some critical differences between the two that investors should be aware of. ETFs can be traded throughout the day, while index funds can only be bought or sold at the end of the trading day at the net asset value price. This means that ETFs give investors more flexibility to buy and sell market price daily shares. ETFs may have lower expense ratios than index funds. This is because ETFs typically do not require a team of active managers to select individual stocks, and they can be traded like a stock, which reduces transaction costs. However, this is only sometimes the case, and investors should compare the fees of each investment option before making a decision. ETFs may be more tax efficient than index funds. This is because ETFs are structured to allow investors to sell shares without triggering a taxable event. In contrast, index funds may be subject to capital gains taxes if sold for a profit. Regarding performance, both ETFs and index funds aim to track the performance of a particular index. Their performance will generally be very similar to the performance of the underlying index. However, some differences can impact performance. One key difference is expense ratios. ETFs typically have lower expense ratios than index funds, meaning investors pay fewer fees to own them. This can significantly impact performance over time, especially for long-term investors. Additionally, ETFs often have lower minimum investment requirements than index funds, which makes them more accessible to smaller investors. Both ETFs and index funds can be valuable tools for investors looking to track the stock market's performance. While they share many similarities, ETFs offer more flexibility and may have lower fees than index funds, while index funds may be subject to fewer tax implications. Ultimately, choosing between these two investment options will depend on an investor's needs and preferences. It is essential to do your research and compare the fees and tax implications of each option before making a decision. In addition to how they are traded, there are some distinct differences between index budgets and ETFs. Number 1. The minimal funding required. Often, ETFs can decrease minimum funding over the index price range. Most of the time, all it takes to put money into an ETF is the amount wanted to buy an unmarried percentage, and a few brokers even provide fractional shares. But for index budgets, brokers regularly place minimums in an area that might be much higher than a standard proportion price. If you have a small quantity to make investments, recollect an ETF with a percentage rate for which you may have the funds, or an index fund with no minimum funding amount. Number 2. The capital gains taxes you'll pay. Thanks to how they're structured, ETFs are more tax efficient than index price ranges. When you promote an ETF, you're usually promoting it to some other investor who's shopping for it, and the cash is coming without delay from them. Capital profits taxes on that sale are yours and yours alone to pay. To get coins out of an index fund, you technically should redeem them from the fund supervisor, who will then promote securities to generate the cash to pay you. When this sale is for a benefit, the internet profits are surpassed directly to each investor with shares inside the fund, which means you could owe capital profits taxes without ever promoting an unmarried percentage. This occurs much less frequently with index funds than actively controlled mutual funds, in which buying and promoting arise more regularly. Still, from a tax angle, ETFs usually have the upper give-up index funds. Number 3. The value of proudly owning them. Both ETFs and index finances can be very cheap to own from an angle of price ratio. You can quickly locate funds that fee much less than 0.05% of your funding in step with year. Another value to search for is trading commissions. If the booking does charge a commission for trades, you'll pay a flat charge whenever you buy or promote an ETF, which could devour into returns in case you're often trading. But a few index price ranges also come with transaction fees while you buy or sell, so compare costs earlier than you choose. When buying ETFs, you'll also incur a price known as the bid-ask unfold, which you see while shopping index price range. However, this expense is typically minimal if you're buying excessive volume, broad market ETFs. Index price range and ETFs are low-fee options compared to maximum actively controlled mutual funds. To determine between ETFs and index price ranges especially, compare each fund's cost ratio, first and principal, because that's a constant value you'll pay the whole time you preserve the investment. It's also sensible to test out the commissions you'll pay to buy or sell the asset, even though those fees are much less vital, except you're buying and promoting often. What index budgets and ETFs have in common? ETFs and index budgets bundle together many character investments, including shares or bonds, into available funding, and they become a popular preference for investors for some shared motives. Number 1. Diversification. Both index price ranges and ETF can help you create a nicely varied portfolio. For example, an ETF based on the S&P 500 will expose you to masses of the USA's most prominent businesses. Number 2. Low price. Index price range and ETFs are passively controlled, which means the investments within the fund are primarily based on an index, together with the S&P 500. This is compared with an actively managed fund, like many mutual price ranges, where a human dealer decides what to put money into, resulting in better prices for the investor. A few actively controlled ETFs exist. However, for this comparison, we'll target the more common passively managed range. Number 3. Strong lengthy term returns. For lengthy time period buyers, passively managed index budgets tend to outperform actively managed mutual price ranges. Passively controlled investments comply with the USA and downs of the index they're monitoring, and these indexes have traditionally shown adequate returns. For example, the overall annual return of the S&P 500 has averaged around 10% over the last 90 years. Actively controlled mutual finances may perform higher within a brief time because fund managers make funding decisions primarily based on present-day market conditions and their information. But the improbability that fund managers will make regular, market-beating choices over a protracted duration, no longer to mention the higher cost ratios, can result in decreased returns over the years versus a passively controlled budget. The most significant difference between ETFs and index finances is that ETFs may be traded at some point, like stocks, while index funds can be bought and offered most effectively for the charge set at the quit of the trading day. For long-time period investors, this problem is of little concern. They are buying or promoting at midday or 4 p.m. It will probably have little effect on the value of the investment in 20 years. However, ETFs can also better fit your needs if you're interested in intraday buying and selling. They may be traded like shares, but buyers can gain diversification's blessings. ETFs may have decreased minimal investments and be extra tax efficient than the maximum index price range. Despite their differences, index finances and ETFs have lots not unusual, such as diversification, low investment charges, and sturdy long-term returns. Regarding performance, there is no clear winner between ETFs and index funds. Both options track the performance of a particular index, and their performance will generally be very similar over time. However, some differences in expense ratios and trading flexibility can impact performance over the long term. Ultimately, the choice between ETFs and index funds will depend on several factors, including an investor's individual investment goals, risk tolerance, and investment strategy. Investors should carefully consider their options and consult a financial advisor before making investment decisions. And as always, stay tuned for more exciting videos coming your way. If you want to know about the top 5 stocks and invest in 2023, check out that video right here, and we'll see you there.